One of the main ingredients to the global financial crisis was that people had no idea what they were buying when they bought mortgage backed securities. The ratings agencies, who are supposed to be independent watchdogs of this credit to be able to tell investors and inform them how risky these investments are, they were asleep at the wheel, and they were rubber stamping all of these mortgage backed securities as AAA rated, i.e., low risk, even though the mortgages and the loans that made up those bonds were actually garbage. Well, surely we've learned our lesson, right? Surely we're not repeating the same stupid mistakes of the global financial crisis now. Well, let's talk to Kieran Van Hest, aka Deso Games. See, he took a page right out of Dr. Berry's book, and he opened up one of these mortgage-backed security ETFs, looked at the bonds that made them up and what was inside those bonds, and what he found might surprise you. This is part one of my interview series with Kieran Van Hest, aka Deso Games. What's up, guys? I'm nobody special, and I'm very lucky today. I have got Kieran Van Hest, aka Deso Games, is here to join us. Kieran, how you doing today?
I'm doing just fine. How are you, Jack?
I'm good, and it is great to have you on the channel. I'm a big fan of your work. Kieran and I were talking a few minutes ago about some of the things. My first experience of seeing his work was just after the Silver Squeeze. I was saying I saw a 3-hour long interview that he did on the old Wall Street Silver channel, and how just blown away I was about it. And he got into everything from MBS to the debt bubble to stocks to precious metals and Tether. And well, all just about everything you said in that interview has happened since that interview was made. And here we are. It's now May 18th of 2022. It looks like it's all starting up. Now, you put something out on Twitter a couple of days ago about a CLO ETF. It was the JAAA ETF. Tell me a little bit about what you saw when you looked into that.
Yes, the Janus Henderson AAA rated CLO ETF, I think is the full name. Yeah. So to get into a little bit of the housing market first, I think we on this channel, you all know about the 2008 housing crash and probably all seen The Big Short. And if you haven't, it's absolutely mandatory at this point. So we all know that the rating agencies have not been very accurate in their ratings. And well, The Big Short starts with how did they do it? Well, they looked. Nobody else looked. And at some point, I just started to wonder, like, have they just not continued to do the same again? Logic dictates that if they weren't punished for their previous bad actions, then moral hazard continues and they will actually do things worse. Since we know that the Federal Reserve has also been buying up mortgage-backed securities at a clip of, well, last 40 billion a month, but before that it was still like 20 billion a month for previous QEs. They've got 2.7 trillion on the balance sheet. And when you're buying that much of anything sight unseen, you can't check it all unless the Fed suddenly hires an army of mortgage-backed securities researchers. They have no possibility of knowing what they're buying. So I basically just thought, well, if the Fed is replacing the big banks and just buying sight unseen, the ratings have to, well, they have to be bad. They have to have pulled the same shit. And how can I find it out?
How many loans do you think we're talking about here? I mean, what did we say? 2.7 trillion in CMBS on their balance sheet?
Well, that's just on the balance sheet. That's not the entire market. If you look at Fannie Mae, where executives have been leaving quite rapidly recently, their combined guarantee book of business from Freddie Mac and Fannie Mae is 7 trillion. So that is just the agency MBS market. That doesn't include non-agency. If you look at the CMBS ETF, a lot of bonds in there, for instance, come from JP Morgan or commercial banks, and those aren't included in Fannie Mae and Freddie Mac numbers. So yeah, the housing market is what, 12 trillion? Something like that. It's not all bad. The houses still exist and they still have some value. It's just that we don't actually know what that value is because it's all been run up by debt. And what is supposed to be AAA rated, because the websites say it's AAA rated, like MBB, like CMBS mostly, like the CLO ETF. It's just not. Now, with ETFs, you can actually see the holdings of what's in the ETF. We all know SLV. We all know PSLV. Though the same thing happens with mortgage-backed security ETFs. Somewhere you can find out what's in the ETF. And I just went and go and looked. That's all I did.
So you open the book and you looked. You're not supposed to do that. You're just hand them your money. Come on.
Yes.
You're not playing fair.
Don't mind the liquidity behind the curtain.
Guy wants to know what he's buying. Imagine that.
Anyway, I can otherwise describe it as the system fucked up. If you look at MBB, you see a lot of names that don't tell you anything. F Gold, 3.5% fixed, whatever. You don't know what's in that. But they also put in there bonds with names where it does tell you what's in them, namely FICO scores. And it says FICO scores below 660. Now, it's not as bad as The Big Short, where Jared Vennett goes filled with FICO scores below 550. But I do know that 660 isn't AAA. And you don't need to go further than that. That's all you need to keep in mind. Because if 660 isn't AAA, but it's in a AAA rated ETF, that means it must have been rated as AAA. Otherwise, iShares can't tell you that it's AAA rated. That would be investor fraud. They would get the SEC all over them. So that's the one protection you still have as a shareholder. The company must tell you everything. So if you read balance sheets and 10Qs, it's in there. Maybe it's worded weirdly and it's under the wrong header, like Evergrande, where they just stuff everything under inventory. But it is still there on the balance sheet. So I just looked at the balance sheet of MBB and it's full of shit. So it's not a long leap to make to think that, well, if they rated obvious shit as AAA, then the non-obvious shit that doesn't tell me anything, I have no faith that that's better rated. And they don't know either. And that's the problem.
So you looked up at the MBB, which is the iShares Mortgage-Backed Securities ETF, which advertises itself as AAA rated mortgage-backed securities. And when you open that up, you looked in there, and there was mortgage bonds that consisted of loans to people with 660 FICO scores. Below 660 FICO scores. And they're calling this AAA rated.
Yes.
Which, if you have below a 660 FICO score right now, go try to get a mortgage. See what they quote you.
On my FICO, I can actually look up the mortgage rates per FICO range. And for 640 to 659, so that's everything below 660, you currently pay 5.859% on your mortgage. So
today's prices is impossible for most people.
Yeah, that on an average loan of 300K, that's a monthly payment of 1,772 per month. And that's the reason why MBB has been failing, because those mortgages simply aren't worth it anymore. Now, the reason why I look for ETFs, this is Des's rule of investing number one in a passive investing bubble. There's an ETF for that. Now, just like with SLV, even when it's not all legit, if everybody thinks it's filled with silver, it will just track the silver price. Silver goes up, SLV goes up, silver goes down, SLV goes down. So the key takeaway there is the price of the ETF reflects the price of the underlying, whatever it is. Now, if you don't understand bonds and yields and slices and all of that, that doesn't matter. That's all complexity designed to confuse the issue. What you simply need to understand is that everything has a price. If it does well, price goes up. Doesn't do well, price goes down, because people don't want to hold it anymore. And if the price of the ETF goes down, since it reflects the price of the underlying must also be going down. And it doesn't matter what the underlying is. If it's silver, then silver's going down. If it's mortgage-backed securities, then mortgage-backed securities are going down. And if mortgage-backed securities are going down, that means that the bonds underlying them must be performing poorly. Otherwise, they wouldn't be going down. I don't need to research any more into mortgage-backed securities. I don't need to know how to buy them or to hold them. I just need to know that the people who do this stuff for a living, who do have mortgage-backed securities on their balance sheet and ETFs like MBB, no longer want to hold it. And they're selling it to the point where MBB has hit an all-time low long before junk credit did. And I can also explain that.
So if people are dumping MBB bonds or the bonds that make up MBB now, they're already selling it. What happens next week or 2 weeks from now in June when the Federal Reserve starts what they told us was going to be their quantitative tightening, and they start unloading, what did they say, 10 billion a month in mortgage-backed securities?
17 and a half.
17 and a half?
They're doing it a little bit more refined than selling. They're simply not going to buy anything anymore to keep the nominal number stable. So what they're doing now, even though they've said they stopped QE, they're still buying bonds. Because when you have a balance sheet of, what is it, 9 trillion, almost 9 trillion, then continually the bonds they bought in like 2008, the shorter term ones, they're already rolling off, they're maturing. So that debt gets rolled over, and because it's maturing on the balance sheet shrinks. So if you buy bonds, it stays level, and that's why you see the balance sheet do this on the chart, because they're constantly maturing bonds and then they're buying it in the market again, and it takes a lot of effort. So there's a little bit of lag, and you see little waves. So with QT, they're simply gonna not replace 17.5 billion worth of bonds per month, and after 3 months, they're gonna scale it up to, I think it was 35 billion worth of mortgage-backed securities. So that's the stuff that's inside of MBB. So what they're basically doing now, and what they're not going to do anymore pretty soon, is buying 1.7 MBBs per month. The entire worth of
wow.
The ETF.
The entire ETF.
Yeah, the ETF has a market cap of 25 billion, but it says that assets are worth about 10 billion. And when you're talking MBB, mortgage-backed securities, you're basically, selling the stuff that's inside of MBB into the market. So it depends on how you want to calculate it. If you want to say market caps of MBB, well, that's fine. Then they're selling 75% of one MBB into the market every month. Wow. Or, well, they're no longer buying that kind of stuff. So the market has to absorb it, which is almost the same as selling something that if you weren't buying previously.
That's liquidity being drained from the MBS market, whether they're actively selling it or not. It's the market getting tighter.
Yes. And this is happening after MBB has already reached an all-time low. It's very important to understand that it's below Lehman.
Yeah, and I saw you mention this in your interview with Rob Kientz over at Gold Silver Pros a few weeks ago. I remember having to do a double take watching that interview and saying, no, that can't be right. He can't be, he's got to be making a mistake. And I went back and looked, and we're talking about a mortgage-backed security ETF is currently trading lower than at the height of the financial crisis.
Yeah.
Couldn't believe my eyes when I saw that. House prices are still at all-time highs. I mean, maybe some markets are coming down, but home prices haven't budged, and these bonds are already trading like the housing bubble has already popped.
I called it, in fact, in March of 2021, because by then, MBB was already trading at COVID lows. We're talking well over a year ago, and junk credit wasn't showing anything. And I can explain that. It's incredibly simple to explain. When the COVID crash happened, we were already over-levered, already going for a financial crisis, and junk, in fact, effectively immediately imploded. We all saw the line straight down. Yep. And you look up LQD or HYG, which are the investment grade or junk ETFs, you can see that they're nowhere near their 2008 lows. That's simply because the bonds on the Fed's balance sheet, the MBS on there, that's not the good stuff. Think this through as a bank. You basically got an unlimited buyer. Well, not unlimited, but they will buy sight unseen a large amount. what do you sell to them? Do you sell your best junk or your worst junk?
Yep.
You sell the worst junk first. You keep the best junk yourself.
It's the same thing with bad money chasing out good money, right? You're going to spend your copper quarters or you're going to spend your silver quarters?
Oh, you don't
You're
even
gonna
have to
hold on
go that deep. You don't even have to go that deep. It's very simple. You've got, you're producing apples. You've got rotten apples. You've got good apples. And somebody will buy apples from you no matter what the quality. Are you going to sell the good ones or the rotten ones? No, you're going to sell the rotten ones because the good ones you can sell to everybody else. Yeah. So in 2020, because Jerome Powell acted quite quickly and just started printing $1 trillion a month, which they did in March of 2020 and April of 2020, junk recovered because, you know, the Fed was vacuuming it all up. So AAA recovered too. Because why would AAA crash if junk can't even crash? And that's where everyone fucked up, because the rating agencies rated junk as AAA. And that is why MBB is lower than junk right now, because effectively it's only a little bit better in credit quality than junk, but it never got bailed out. So the supply is much larger compared to what the supply of junk was before. And that's why it's going first. You can see that with CMBS too. In the corporate market, same thing. That crashed to an all-time low before MBB did.
So there you have it, folks. Deso actually opened up those mortgage-backed security ETFs, looked at what was inside them, and what he found is the same stupid mistake that the banks and the ratings agencies were making during the global financial crisis. They've done it again. And as always, the debt market is the first to sniff it out. Those mortgage-backed security ETFs are now trading actually below where they traded at the height of the financial crisis. Somebody forgot to tell home prices that. Again, folks, this is just part one of my interview series with Kieran von Hest, a.k.a. Deso Games. He does some fantastic work, and if you want to know more about him, you can see some links down below to his website, to his Substack, his Twitter feed, and even a couple of books that he's written. I highly recommend all of them. Kieran is a brilliant analyst, and I think we're going to see a lot from him in the years to come. Until next time, live small and dream big.